In Bitcoin, many of us have had this saying, not your keys, not your coins, right? Every diehard maxi will tell you that.
Bitcoin is more of this equity type asset that can't sit. The Bitcoin backed loan was our first product.
We see this as the long-term asset. We want to give it to our children. All right, thank you very much for joining us on the stage today. My name is Stephan Livera. I'm host of Stephan Livera Podcast, a show about Bitcoin. I'm joined today by my friend Joe Kelly. He is the CEO and co-founder of Unchained Capital. So for those of you not familiar, Unchained Capital help out with things like collaborative custody. They have lending against, borrowing against Bitcoin and trading. And so our topic today is, a bit of a play on words. How do you hold the revolution, right? Many of us talk about being a Bitcoin hodler, and of course, is Bitcoin a revolution? Is it an evolution? Let's get into some of these topics. So let's talk a little bit as a bit of a sketch of holding Bitcoin. What does that look like nowadays, in this industry? Do you want to start there?
Sure. I think that I like the revolution idea because I think it keys into two fundamental things about Bitcoin being a form of sound money, limited scarce supply, but also in the holding of it. As a bearer asset, it's kind of a return to the realness of things, the realness of transferring something that isn't rehypothecated or just exists in a stack of financial layers. And then it's also got this transparent blockchain. So you can look at all roughly 20 million Bitcoin that exists and are currently issued, and how do those sit in addresses, how old are those addresses. That was one of the insights that led us to start Unchained, was seeing the large balances of Bitcoin that didn't move, that people are holding for the long term. And then a rough trend that's held, because in the earliest days of Bitcoin, the only way you could hold it was self-custody. So a lot of the early holders were already doing that. And then a trend that's maintained, I'd say, over especially the last 5+ years is at least 40%, as much as 50% probably of Bitcoin is not held by an intermediary. So it is still in some self-custody format. Piecing together the data, it's not imperfect, but you have things like public statements from Ledger, the hardware wallet manufacturer, that they help secure roughly 20% of crypto. So that's on the order of about 4 million Bitcoin on Ledger devices. And so you can kind of add that up and you get to this idea that 40 to 50% is in self-custody. And then there are, the other way you look at it is public figures from custodians like Coinbase, and looking at how much they secure. They have, I think, on the order of 2 million Bitcoin alone at Coinbase. So it's quite massive. And that's really the spectrum, I'd say, between pure self-custody, if you're using your own setup, your own software setup or hardware wallet, or letting it sit at a Coinbase. And then a service like an Unchained is somewhere in the middle, helping equip our clients to hold their own keys so they can move without us, but we're still an institution that's backing them up and helping them through that process.
Yeah, I think it's a good overview. And so as people talk about Bitcoin today, it's maybe very common that, especially at the larger professional level, there's kind of a lot of talk about these different custodians, or in practice, you may have some Bitcoin on a platform, but actually it's being held by one of these large custodians, right? And I guess there's probably kind of a few, let's say 5 or 6 big custodians in the US, right? As you mentioned, Coinbase Custody, BitGo, Anchorage, Fidelity Digital Assets, BNY Mellon, NYDIG, maybe Gemini. It's kind of in that, let's say 6 or 7 are kind of the big, well-known US custodians, and then maybe there's a few in Europe as well on that side. So that's the custodial world of it, and then you've got, let's say, the collaborative custody aspect of it, which you represent, and maybe there are others out there who are doing that, and then full DIY, right? Just hold your own keys and do everything yourself. So how do you see that trade-off? Is it okay, let me put it this way. In Bitcoin, many of us have had this saying, not your keys, not your coins, right? Every diehard maxi will tell you that, but then there are a lot of people who come into a more custodial form of Bitcoin. Why is that? Is it for legal reasons? Is it just for comfort reasons? Why are they going more to that side of things as opposed to collaborative custody or full self-custody?
Yeah, I mean, it's a mix. We're creatures of convenience and ease, especially as you're easing into a new asset or owning Bitcoin, you will lean towards things that look like your brokerage account, or what is it like to buy securities in a Schwab or Fidelity type account. And so that's kind of what it feels like in buying Bitcoin on Coinbase. So when you're an individual, you're kind of reaching for that as maybe your first option. On an institutional side, if you are in a firm that there's like multiple decision makers, or at least some group of people that have to discuss and look at various risks, you tend to first look at who is trusted, who's the place other people are storing their money at, and you kind of default to that. That makes it an easier choice or an easy sell in risk committees or investment committees. So that is where people tend to get their feet wet. It's rare, although we do onboard people to their first Bitcoin purchase in a self-custody type format at Unchained. That's definitely a smaller percent. And then I've observed, it's not perfect, but there tends to be a one-way funnel of once you do hold Bitcoin for a longer period of time on a centralized custodian, as you learn more about it, you hear refrains like "not your keys, not your coins." But then especially as you might have been exposed to a failure at BlockFi or FTX or these kinds of industry events, you wake up to, was the industry term of counterparty risk. That's something that for a lot of consumers and a lot of individuals, they don't really know what that means. What is a counterparty? Who are they? Not recognizing that Bank of America might be your counterparty, but you're keeping your checking account. That's just not a way we tend to think about the world until you're shocked by something, until some event makes you understand that you were trusting that party for something that they failed to maybe do.
Now, perhaps what's also motivating some of these decisions is access to particular kinds of financial services. So as an example, there could be a hodler who wants some fiat liquidity and he wants a loan to borrow against his Bitcoin to get some fiat to whatever, buy a house or pay his bills or buy a business, or maybe he wants to go long Bitcoin. All right, there's just different ways people are doing that. Can you contrast some of these financial services across the different ways it's being done, right? The full custodial style, maybe it's like the familiar UX and it's all the same experience that people are used to, versus in a collaborative model where maybe you still hold one key and you are guaranteed no rehypothecation, and that's worth something. And so can you contrast the different financial services available in these different custody paradigms?
Yeah, so I think, certain fundamental ways financial services works is most intermediaries or financial services firms make money on flows of the assets being moved, or certain transactions that are leveraging assets in some way, perhaps lending them out to other firms. And so that's kind of just the state of the financial system we live in with dollars and fiat, and that it's something we're used to, but it tends to happen just behind the scenes. You have securities in a Schwab account. Those securities may get lent out. They may not actually quite, quote, be there. And for most of the time, 97% or some high percent of the time, it's okay. It's not really affecting you. And so I think that's a way that as we've approached designing financial products at Unchained, recognizing kind of this Bitcoin native idea that it's a true kind of equity-based asset. It's not a form of credit or something issued by a government. That the fact of it being there, the fact of it not moving but being movable when you need it, there's a kind of potential energy in that fact, or that state of your Bitcoin. And there's a psychological thing that we're sort of taught, that your money should be invested, or you should take your cash or otherwise a liquid asset and put it in things that have yield, and so that go up over time. And that's just something we're trained on because of the fact of inflation. But if Bitcoin is more of this equity type asset that can sit, that can have this action potential to use for short-term liquidity needs, either because you need to sell some or you'd like to get a loan against it, that's very practical. And then you have to just consider who is the counterparty that you're placing the Bitcoin with to get the loan from. What are they doing with it? The format we have at Unchained is one where the Bitcoin lives in a multi-sig address. The borrower, the client that provided the Bitcoin, they get to hold one key. That doesn't necessarily guarantee rehypothecation, but it's a form of strong cryptographic proof. You know there's a linkage between your hardware wallet, your device for securing your keys, and this address that was provided to you and where the Bitcoin lives for the duration of the loan. And it's been part of what, I think as our record tries to prove at Unchained, we've originated over $1 billion of loans against Bitcoin as collateral and have never had a loan loss. And part of that's because the collateral has always stayed put, where firms like BlockFi, Celsius, and a lot of the ones that went under, they were taking those client assets that were being lent against, and they were relending those out to firms, which at the end of the day was really kind of one black hole of a hedge fund in Singapore that took out the market in 2022. But yeah, there's not really these layers. There's not really a robust credit mark around Bitcoin. So it's not usually advisable to just enter into like a yield type strategy around your Bitcoin unless you really know what you're doing. And then, yeah, I think the idea is that a lot of how financial services firms are structured, or once the assets are here, we can do a lot of things for you with it. Just keep it here. And that, those things look like helping trade, helping do options, write derivatives. And so custody as a standalone usually is just not a very good business model. And most all firms are making their money in those extra services. But those do come with a lot of risks.
Right. And I think that's also an interesting point that some of the custodians, as you said, they're not necessarily making a lot of money on the custody service of it. So maybe it's seen like some of these custodians are like, hey, get them in the door, and then we'll sell them some of these other ancillary services on top of that. And okay, maybe that could be lending, or it could be some other like kind of some shitcoin staking yield thing or whatever. Like it could be some other thing that's where the money is being made per se. But to your point, respecting the cryptographic, the keys aspect of it, there are ways to build some of these services in a way that is a little closer to and matches or aligning with the not your keys, not your coins ethos that we all talk about in Bitcoin.
And that's kind of the we have some former bankers, some former bank executives that work with us that have been at the banks like Silvergate and others that really sought to, in their words, take banking and move it into Bitcoin. And unfortunately, they got crushed, or a lot of those stories didn't end well in the last 2 years. But where they see working with us as valuable is we're taking kind of this Bitcoin native principles, like understanding, this is a new, almost evolutionary route, or like early species of financial service, but in more of this kind of equity, strong, hard money, collateral based system versus the fiat system we've all grown up with and seen over the last many hundreds of years. So Unchained and I think firms like us are kind of really starting from that Bitcoin first principles. And it's part of my own personal journey, not having been in financial services before starting Unchained, was a real benefit. As I wasn't clouded with all these expectations. I wasn't clouded with these preconceived notions of how financial services should work. It was just kind of built up more on the expectations I have as a long-term Bitcoin holder, and that I happen to share with our clients.
On the topic of Bitcoin as a revolution and more people adopting it, I think it's another super hot topic. Arguably, super hot topic nowadays is like the treasury company stuff, but also I think probably the next most hot topic is lending. And I think we are seeing a lot of interest. And when I talk to Joe, or even when I talk to other people who are involved in any form of Bitcoin lending, there's a lot of interest. And this is on both sides of that ledger, right? Both on the Bitcoin hodler borrower side of that question, and also on the capital provider side, as in someone who has fiat. And maybe this is another way for people to, quote unquote, participate in this revolution, because let's say you may be somebody who is maybe newer to Bitcoin and not comfortable to have a high Bitcoin exposure, but maybe you have some fiat and you would be comfortable to put that on some of these platforms or be a capital provider and get yield. Now, where's the yield coming from? There's a borrower who's paying that yield, but I think that's also an interesting dynamic we're seeing. Do you want to comment a bit on the growth in this Bitcoin collateralized lending market that we're seeing recently?
Yeah, it's fine. It feels like it's finally here, honestly, kind of having worked in the Bitcoin-backed loan was our first product. We gave our first loan in the summer of 2017. Really right away, it was like, our interest rates are maybe 12% or so. That was roughly around our cost of capital at the time. And I thought, surely, within a year or two, this is such pristine, such great collateral. A Bitcoin-backed loan should cost you as much as like a mortgage on your home. But it's been illuminating, just learning how capital markets work, that between incentive structures or what the buy boxes for certain forms of credit look like at large capital allocators, or just the way banks were hamstrung for so long from participating in the space, that just all those factors together continue to make it a very high cost of capital type of product that now I think trackers like Unchained, and just now that the banks are less hamstrung, there's just a lot more capital kind of entering the space. So it's meeting a very worthwhile demand. I think as long-term holders, we don't want to sell for either the tax hit or to lose out in future gains. And so for our clients, the borrowing behavior is predominantly around investment activities. So people that are buying investment property or expanding their businesses and leveraging Bitcoin as this capital asset to do that and invest in other areas of the economy.
Yes, I find that really fascinating, and maybe this is something that it's interesting that it took a few years to get here, right? Because when did you start? 2018 or 17?
17 was our first loan, our first launch.
Yeah, so it's 2017. And, there have been some of these lending products, but it's only, I would say, the last, let's say, year or so-ish, that it's kind of really, it's really ramped up a lot. And now I think there's a lot more interest in this on both sides of that. And so maybe that's something that people, and even Bitcoin people who have some fiat allocation, maybe they're comfortable to sort of come in on the allocator on the
Some of our earliest capital providers were, people that most of their wealth came from their Bitcoin, and that they might have sold it, in the 2017 cycle, kind of a thing. So there's that people straddling both sides for sure.
Yeah, and it's I think for a long time a common criticism has been, oh look, the rates are too high, but they're whatever 14-15% on the loans, and they've come down a little bit. But I think the other reflection that comes to my mind, I'll get your reaction on this, is I think it just shows that house loans, mortgage loans are government subsidized. That's why they're so cheap, and it's whatever it is, 5% or 6% for 30 fixed for 30 years. And in many other countries, you don't get that, right? For example, I'm from Australia, well, born in Sri Lanka but raised in Australia. But the loans there are normally variable, and max you could fix is like 2 to 5 years fixed. But here in America, it's kind of a common thing that people have like a fixed loan for 30 years, and yet it's so much cheaper than the Bitcoin rate.
Yeah, and that's it's really a distorted capital market. I mean, thinking about things on the basis of flows and sinks, a sink being the end of a flow, or where does it kind of sit, and much of lending is because the raw resource is dollars. So you're lending dollars, you're constantly looking to replace those dollars you just sent out. And so where do those dollars come from? And finding that ultimate sink or place for the loan or the paper to sit. And in the mortgage system, we have Fannie and Freddie Mae, these large government-backed or government-owned at times enterprises that they're the sink, they're that final home for the mortgage. So all the intermediary banks and mortgage originators get that benefit of always knowing there's some final home or some place, some buyer at the end of that mortgage origination process. Where in our loans, you haven't had that. Where does now and really in the market, I think, to describe it, there's really only 1 year term type products. You don't have yet truly like longer yield curve might not be right, but there's like longer tenor loans, 3 and 5 year plus loans, even though those might be considered potentially less risky, just watching Bitcoin's price through cycle. With a high risk lens on Bitcoin, people want shorter tenor loans from at least the capital provider side. And so, you haven't had this place of where can now like $1 billion or $5 billion worth of loans against Bitcoin sit at the end of that kind of value chain. It's coming, though. Banks are coming in. I think you'll see a lot more bank balance sheets that hold this kind of paper. You've had large, very institutional actors like Tether kind of being a quasi, central bank for the crypto economy. And so that's a place where a lot of this paper kind of ends up getting held at the end of that process.
Yeah, and so do you have any, you were touching on this, but around longer term loans, do you know when that might be feasible, at least in the American market, or even like a revolving credit facility? Like, is that in the horizon? How far away do you think that kind of thing is?
Yeah, tough to predict. I think it will happen. I think certainly within the next 1 to 2 years, companies like Unchained will start to offer longer term loans as the capital market base for these matures. And lines of credit, those pose always the interesting challenge of, again, a lot of the funders in the space look like credit funds, and credit funds, once they make a commitment to fund something like a loan portfolio, want it out. They want all the capital out. It's really usually banks, again, as there's a class or a sector of capital providers that are more suited to lines of credit because the drawdown or the going from 5% utilization to 100% utilization on a $1 million line of credit, like that's where the money's made. It just comes right out of the bank. So there's there might be an unused fee or things like that you have to pay for, but you tend to not see so many structures like that in a more like traditional credit fund environment.
Gotcha. Okay, so we've spoken a bit about the lending component of it, and in this context, holding one of the keys. Now, let's talk a little bit about holding the revolution and what that means for us holding long-term things like inheritance, transferring it to our families, and putting things in the right structures. I know you also have the Gannett Trust, so maybe we should talk a little bit about that also, because many of us, we see this as a long-term asset where you want to give it to our children. And what are some of the structures that make sense for that? Yeah, so
I kind of think about this in layers. Again, back to the idea of this sort of Bitcoin native layer, which is very technological in its expression. It's cryptography, it's computers, a network that you talk to when you submit transactions. So once that's in place and you're secure, you have your own collaborative custody or your own multi-sig setup for your Bitcoin holdings. There's another layer of problems that have to do with people, relationships, communication, and the legal system. So the conveyance of Bitcoin to your heirs may look seamless to the degree you have a small family and it's assumed your wife or a child gets your assets on death, and they know where the keys are, they can go get it. But what if your family situation is more complex and there might be other claimants or a cousin or an aunt that thinks that they were promised the Bitcoin. And so now that starts to enter more of that social and legal layer of you need for defense for your heirs to understand that like they are the truly rightful folks to receive the Bitcoin in the instance of death. And so structures we have in traditional finance for this are sometimes trusts, a trust entity that has explicit instructions about what happens, or is kind of an asset protection type trust. Of course, also wills and inheritance plans, kinds of things are natural, a tool for people. And yeah, the role of something like Gannett Trust, which we started and was licensed early this summer in the state of Wyoming, that's there to act as a trustee. So once a trust is set up and you need a qualified institution to act in your behalf or on behalf of the assets and inheritors or beneficiaries of that trust, Gannett is now an institution that can do that and do it in something like this more Bitcoin native format of multisig, where the trust company is holding a key or can hold a key collaboratively with the trustees. And so that's just, again, ways we're trying to pierce into that existing legal system and these constructs that map into the form we'd all like to hold our Bitcoin in, the form we prefer to hold Bitcoin.
Of course. So, many of us who believe in self-custody might be having, our cold card with our 12 words written down, or multi-sig with multiple, let's say cold card and ledger and Trezor and whatever else. And so then it's like, how does that map to the legal system in how we hand it down, right? We're going to hand it down to our wives and kids after we're gone or whatever. So how, for a lot of people, right, they're not as tech savvy and they're not as comfortable with, dealing with physical hardware wallets and so on. Where do you think that's going? Is it around having companies and firms that are good at consulting there? Is it service providers who are interposing and helping that transition process? What does that look like?
A big part of Unchained's business is just the onboarding and helping people get that first level of comfort and peace of mind that I've set it up correctly, I've initialized my wallets correctly, I'm storing them correctly. And so I do feel like that's an evergreen business for a very long time. It's just more and more, many millions of people are going to be coming online to wanting to do this. And then there's a sustaining business, at least for us at Unchained, and the support of those folks when there's questions or there's a firmware upgrade with one of their hardware wallets. What do they do? Or they lost some part of their key management system and they need somebody to help and advise them what to do next. So I do see it as a very enduring business model to have this kind of service around self-custody, the onboarding and the ongoing support. And it's a model that I think also thankfully in the US so far not been under too grave of threat. I think that internationally, unfortunately, there are regulations that I think created the same amount of clarity we get the benefit of in the US. Definitions like you are only a custodian if you have unilateral control of someone's Bitcoin. And it's such a precise way. I'm grateful it was put into now statutes and things like how FinCEN, for instance, polices money transmitters as of understanding this test of does the firm have unilateral control or not of the client Bitcoin. If yes, they're a custodian, that they're now under certain encumbrances of things they need to do. But if not, then it's kind of more free and open. And I think that just in terms of timeliness, and I think with folks like Senator Haggerty around here, is something to pay attention to is watch. There's been a piece of legislation, it's been called variably the Keep Your Coins Act. It was first introduced in the House. It actually passed through in the version of the Clarity Act that passed earlier this year, but is kind of in debate in the Senate around this, what's called the market structure bill. And that's something I think keep an eye on, because it does contain some language that really helps further protect this right to self-custody, which kind of goes back to very, very early American rights, or just this idea of like our Constitution protects this idea of property rights and our ability to hold our own property. And so I'm really looking forward to that legislation passing by the end of the year, because I feel like that's going to really seal off the way a regulator could impinge on this right or threaten this idea that we can hold our own Bitcoin.
Excellent. Well, I think that's all we have time for. I hope you found that educational. Everyone, please put your hands together for Joe Kelly from Unchained Capital.